The myth of diversification. You have been lied to your entire financial journey. Financial advisors and online gurus alike tell you to diversify, to lower your risk. But in reality, diversification is just a safety tax that guarantees you will be an average person and have average investments. Just take a look at this heat map I have in front of you. This is a representation of the American economy, also the S&P 500. Many people buy into this, expecting diversification and thinking this is the easiest way to get wealthy over time with lower risk because it is safe and diverse. But you'll notice something interesting when you're looking at this heat map. You'll notice that there are these larger blocks that take up a majority of the heat map section. And what are these? These are the Magnificent Seven. And you can notice just by looking at this heat map that diversification is actually a myth. And when you're buying the S&P 500, you're actually just buying the Magnificent Seven plus the dead weight of 493 obsolete losers. And this can be shown even further when you look at the total market cap share the Magnificent Seven has of the S&P 500, which is approximately 36%. Now, all this means is that when the Magnificent Seven does well, the S&P 500 goes up with it. When the Magnificent Seven does poorly, the S&P 500 goes down with it. Now, the difference is the amplification. Because you are carrying the dead weight of 493 losers on your back, your gains are muted in the long run. And this can be pointed even further. Now, we take a look at this map here. This is an interesting one because this shows essentially the Magnificent Seven versus the S&P 500 of equal weight distribution. So what that means is this bar graph at the top here represents the Magnificent Seven. This blue line here represents the S&P 500 when the companies have an equal weight distribution. And what you can see is that this gap between the lines isn't safety. It's just cost of your fear. By diversifying, you are voluntarily taking the best performing assets in history and just diluting them against regional banks and dying retailers. And you can see this amplification just occurs when the Magnificent Seven does poorly, it goes down, but the S&P 500 goes down as well, just not as much. And the same thing happens over time when it goes up. It goes up more in the Magnificent Seven, and the S&P 500 is a lot less. So you can see from the beginning of this chart in about October 2023, you have lost a pretty significant amount of gains, almost 80% difference from trying to diversify in the S&P 500 versus just sticking to the Magnificent Seven. Now let me break this down numerically using a $10,000 investment from the same time frame of around the end of 2023 into present day. So today I'm going to break it down against 4 different scenarios here. So the first we can see is the safe haven, which is the S&P 500. You put in $10,000 and you get a 54% gain. Pretty good. You end up with $15,400 in today's money after about 2.5 years of investing. Now, what if you were just the tech bro and you invested into the Magnificent Seven? You would see you have a much larger gain of 115%. This equates to about $21,500, a much larger, almost double gain, essentially, over the S&P 500. Now, what if you invested in actual hard assets? Now, investing in the S&P 500 and Magnificent Seven and just stocks in general isn't the only answer. Now, what if you invested in gold? Gold has had an absolutely phenomenal year, and you would see that if you put in the $10,000 in the same time frame, you would actually get a 137% gain, equating to about 23.7K. This is actually a fairly large jump from the S&P 500, investing in an actual hard asset, and actually outperforms the Magnificent Seven. Now, if we take it even a step further to the hardest asset that's actually been created in history, which is Bitcoin, you can see in the same time period, it's a 271% gain, equating to about $37,000. Now, this is significantly more than the S&P 500, and all it took was just for you to eliminate the safety tax and to actually have conviction in some harder assets. And I also want to break down the anomaly play on what happens when you do fully stretch and get rid of the safety tax. And that is something I like to call the AI sniper. So this was someone that invested $10,000 in the same time period in 2023 into Nvidia, and they got a whopping 365% gain, for equating to about 46K. And what's interesting is Nvidia is part of the Magnificent Seven and the S&P 500. And what the safety tax does is it just essentially eliminates all of these potential gains you could have had just because you want to diversify and put your assets in about 493 broken companies that are just weighing you down completely. So here, if we switch over to this chart, this is a percentage timeline view from the end of 2023 period I was referring to present. And you can see it here on this scale that Bitcoin has been the king asset overall compared to the S&P 500 and for gold. And again, you can just see that the dilution of just buying the S&P 500 does compared to these other assets. Now, of course, Nvidia was the anomaly, but if someone actually did essentially do their homework, develop conviction, had a low time preference, they would have had reaped the rewards way better than someone just buying the S&P 500. And the same can be said about gold, same can be said about Bitcoin, and same could be said about other Magnificent Seven. The same concept applies. If you have conviction, you eliminate the fear factor and actually study what you're investing in, you will reap the rewards and understand that diversification is a myth. Because at the end of the day, we all know, switching to this chart, this is the M2 money supply. And this just reiterates and shows how the money printing will never stop, which means that assets will always keep going up. So everything you buy, the S&P 500, gold, Bitcoin, Magnificent Seven, all of these companies or commodities providing real world utility and value are just going to keep going up. And essentially, if we know that this is the case and the money printing will never stop, why are we just going to subdue our gains to the average and just have a bunch of dead weight fiat apocalyptic companies when we can actually invest in real assets and reap real rewards? So, the moral of the story of today's lesson is I want you to understand that diversification is actually a myth. You're not actually being diversified. You are just essentially a byproduct of the money printing, and everything just goes up with it. The difference is what you actually park your money in your portfolio, and that's going to equate your actual gains over time. So the moral of the story is I hope that this can kind of change your perspective a little bit so you can understand that diversification is just a safety tax, and ultimately you're just sacrificing gains for buying the same thing. And it's just interesting because a lot of people talk about buying the S&P because, tech stocks are too volatile. But all you're doing is you're just buying tech stocks and just diluting it with garbage, essentially. Like a lot of these ancient companies, of course, you could pick a few in a basket and I'm sure they perform well. But overall, you're just diluting it. And people think that they're saving themselves by buying this versus not buying individual stocks or commodities or assets. But the thing is, you're not saving yourself. You're just diluting your gains for no reason. And I'm not saying don't buy the S&P, like don't be average and don't have that safety net. But it is very important that if you actually want to make money as an investor over time, you need to develop conviction and understand that there's no point in diversifying in 500 useless companies. It is better to just pick a couple, develop conviction, have a low time preference, and over time, you will reap the rewards. So anyways, that's enough from me today. I hope everyone enjoyed this video. If you enjoyed the content, please ensure to like the video and give me a subscription. And I hope to see you guys in the next one. Take care.